Good morning. My name is James Pinchbeck and I'm Marketing Partner with Streets Chartered Accountants. It is my pleasure, on behalf of our firm and Carter Jonas, to welcome you to this special property update titled The Next Footings in the Property Market. Before I start, a little housekeeping, so to speak. This session is being recorded and will be shared with delegates and will be available online after the event. You'll be able to download the slides at the end of the session, and these will be shared also with delegates. If you have any questions for the speakers, please do post these either in the chat function or at the end of the session. We will take questions. Hopefully, by doing that, if we should finish on time, but also we will stay online for any questions that may arise. Joining us for the presentation from UK estate agents and property consultants Carter Jonas are Dan Francis, Head of Research, and William Ruck, Partner, East and Commercial Team. Dan will talk about the economic outlook and the implications for commercial property performance. I think a highly topical topic, I can say that, given the last 12 months in the sector and the different ways of working and the demands on commercial property and residential property. Will's presentation will then delve into the dynamics of the office and industrial markets in and around Cambridge. To conclude, Will and Dan will give their views on the future of the office and the impact of the shift towards remote working. Following on from Dan and Will's presentation, Street's corporate tax partner Luke Prout will focus on commercial tax reliefs. Luke will cover specific tax reliefs for property owners and developers undertaking large developments or refurbishment projects in the commercial sector. Concluding today's presentation, Street's tax partner Jenny Brown will look at changes to the taxation of residential property taxes with a particular focus on property landlords, residential property landlords. So without further ado, it gives me pleasure to hand over to Dan for his presentation. Thank you.
Thanks very much. Well, I'm going to start off by looking at the economic context and then move on to property market performance. Right, just having trouble moving the slides. Okay, here we go. Right. So firstly, looking at what's happening with the economy, I guess we've got two things going on. We've got structural changes happening in particularly the office and the retail sectors. And I'm going to talk some more about the office sector and how we see the longer term outlook for that in my presentation at the end. But really looking at more the cyclical effects. The chart you can see shows in the orange line where we've been so far in the current recession, the massive 20% fall in output that we saw following the initial lockdown, the rapid recovery, then the slight sort of backtracking we've had in the first quarter of this year, where output fell by 2.5%. Ordinarily quite a huge fall in output, but in this context, really not looking that bad. And then we can see in the dotted orange line where we think we're going. And we're really quite upbeat about the recovery. If you look at survey evidence, PMI indices, for example, they're all really showing some quite positive numbers for growth. And we think on current forecasts and survey evidence that the economy should have reached its pre-recession peak by the end of this year. So that means that there'll have been essentially a 2-year recession, which is actually pretty good in context. On the chart, I've also shown the early 90s recession in the blue line and the global financial crisis in the green line. The early 90s took 2.5 years to get back to pre-recession output. And the global financial crisis, you'd have to go way off the right-hand side of the chart because that actually took 5 years to get there. So it's been very sharp, but relatively short in comparison to other recessions. And I guess another key feature of the recession has been the disconnect between output and what's been happening in the labour market. Obviously, this has been largely influenced by the coronavirus job retention scheme that the Chancellor put in place. Pre-recession, unemployment was 3.9%, and that's risen to only 4.8%. So that's not the sort of huge rise you would expect given the economic shock, although there are still around 4 million people within that furlough scheme. And I think that the key feature to watch this autumn is really what happens to the economy as that scheme and other supporting measures are withdrawn, I think we will see an increase in unemployment. Forecasts are currently suggesting it'll be about 6% by the end of the year. But compare that to the global financial crisis when it reached kind of around 8%, and that's a pretty good result. And in fact, we are seeing labour shortages in some sectors of the economy. If you look at sort of hospitality, for example, and construction as well, I think seeing shortages not only in labour but also of materials, and some quite rapidly rising prices in some parts of that sector. And I think that brings me on to the last point, which is around inflation. Currently, inflation below the Bank of England's target of 2%. It's at 1.5%, but it has risen quite sharply. If you look at forecasts, most forecasters are expecting inflation to get back to around 2% by the end of the year. But I think there are risks around a period of higher inflation, as potentially demand could get ahead of the capacity of the economy to provide extra supply. We've got supply chain pressures around the world as a result of COVID and other factors. We've got rising commodity prices. Inflation in the US is going up quite sharply. So I think there is certainly a risk that we could be in for potentially a period of somewhat higher inflation. So turning now to the commercial property market, the chart you can see shows rental growth over a period of 3 months in the key sectors: retail, office, and industrial. And this is taken from the MSCI monthly index. So that's an index of average institutional grade property based on valuations. And really, it shows the huge mismatch between the different sectors, the huge divergence we've seen between the three sectors, the differing fortunes. On the retail side, we can see that really over the whole 3 years on the chart, average retail rents have been falling. The rate of decline really sort of peaked last summer at around 3%, but retail rents still falling by 1.4% per quarter, and they've fallen by 8% over the last year. So those sharp falls continuing, but it's not all doom and gloom in the retail sector. There are some positives. We've got the coiled spring, as it's been described, the large level of household savings that have been built up over the recession, which I think will start to be spent and will certainly buoy consumer spending in the coming months. But also we're seeing things like alternative uses coming into the high street, things like medical uses, taking the opportunity to come into locations which wouldn't have been affordable before. And of course, some sectors have done really well over the lockdown period, essentials, DIY, furniture, and so on. And local centres have done really well as well. People have rediscovered shopping in their local centres, and secondary locations, which are perhaps generally sort of more affordable, are encouraging retailers in. So there are a lot of positives, as well as of course the negatives around sort of loss of anchor tenants and sort of oversupplied fashion and so on. But I think we're in for certainly some further falls in the retail sector. Going to the green line at the opposite end of the spectrum, the industrial sector, well, that's been going great guns. Rental growth at 1.4% per quarter. At the moment, its growth has risen by over 3% over the last year, and that figure will, I think, accelerate as that quarterly growth is accelerating that you can see on the chart. And really, the industrial markets, we've seen a significant increase in occupier requirements this year, and there's a real diversity of requirements. It's not just the Amazons of this world, although they've still been taking a lot of space. I think they've taken 1.5 million square feet of distribution space already so far this year. But we're seeing demand from sort of parcels operators, the automotive sector, high-tech manufacturing. There's still requirements from the NHS and so on. So a lot of demand, but actually a shortage of stock. And this is what's really driving this rental growth. And areas like urban logistics, a real shortage of urban sites for that last mile delivery. And we're also seeing a huge demand for open storage sites, which is something that we're looking at the moment, which are being increasingly required to service some of the urban delivery with sort of van and HGV storage and so on. And land values have shot up. Land values have increased by 30% over the last 3 years, and that's really a reflection of that tight supply. And then in the red, finally, the office sector, you can see that's kind of in the middle. Office rental values have been pretty flat. I think that's actually pretty good outturns, considering everything that's been going on in the sector. This next chart just shows take up in the regional office market in the key centres that we cover, what we call our commercial edge centres. And that shows that actually 2020 take up was pretty resilient, only about a quarter below the 10-year average. And Q1, it's been about a third below the average level. So although demand is subdued, it's not a complete washout. There is still demand, particularly at that sort of prime grade A part of the market, and also things like laboratory space, huge demand in that part of the market. So at the prime end of the market, actually, it's still really a kind of a lack of stock. Really, I think is a key aspect. Moving on briefly to the investment markets, I mean, there's been really a considerable resilience in activity given the broader context. As you can see in the chart, more than £6 billion was transacted in Q1. And although that's less than half of the previous year, you know, that's still pretty good. And there was, as you can see, a very strong into last year. A lot of that's being driven by overseas buyers. More than 60% of the value of transactions in the first quarter was from overseas. And areas like distribution, warehousing and quality, multi-let industrial are really highly sought after, as is lab space. I mean, lab space is at a premium. There's really very strong competition for the few purchasing opportunities in those markets. Interesting thing about Q1 is that the orange bar there, the industrial transactions, that actually overtook office transaction volumes for the first time, shows really the strength of that's in industrial demand. This slide showing average equivalent yields by sector, again using the MSCI index. And you know, if say a picture tells 1,000 words, and I think this one really does, showing the huge structural shift that's occurred over the last decade. You know, industrial used to be the highest yielding sector, and that's now the lowest yielding sector. So yields going down means that you know, investors are increasing the price that they're willing to buy at. So those industrials that yields are still falling, and there's really quite strong capital value growth for the industrial sector. Industrial capital value is up by nearly 12% over the last year. And that's in strong contrast to the office sector, where values have fallen by nearly 5%, and retail, where values have fallen by nearly 10%. So again, those really significant differences between sectors. So really, to summarize, a strong economic bounce back led by the consumer and rising business confidence, resilient labour market, but I think we have to watch to see what happens later this year as state support is withdrawn. There's this strong sector differentiation. And really, I think a key story is that the urban landscape adapts into the changes that are going on. And on the investment side, a continued significant weight of money. But as I mentioned, potential for inflation to increase. So that's the broad outlook. And I'll now hand over to Will to talk more specifically about the Cambridge market.
All right, morning all. Hope you can all hear me okay. Yeah, my name's Will Rook. I'm a partner in the commercial agency team at Carter Jonas in Cambridge. I've been invited along here today to give you an overview of the local property market and perhaps provide a bit of colour on some of the themes that Dan's mentioned in more of a local context. So I thought it would be helpful for those of you not familiar with Cambridge just to put this map up, which is a very simplistic overview of the Cambridge office and industrial market. The green sort of zone around the outside is what we call Zone 4, and this is the sort of outer town business parks, Cambridge Research Park, Haverhill Research Park, Evolution Business Park, etc. The yellow zone in the middle here is what we would call the midtown. So this is kind of offices where they're sort of pepper potted around the city rather than in any sort of critical mass. The red zone, which is the blot at the top, is Zone 2. This is science park, so Cambridge Science Park, St John's Innovation Park, and Cambridge Business Park. For the purposes of this section, we'll refer to that as the Northern Fringe. And then the final zone is the blue dot in the middle, and this is the CBD area. And some of the photos around the outside here, just to give you a bit of a feel for the type and quality of the buildings in and around the city, with the buildings on the right-hand side being the Science Park buildings, and then the top left there is 5060 Station Road, which is the latest building to have been completed in Cambridge. And those of you who visit Cambridge regularly, as you come off the train, you'll recognise these buildings as the CBD is pretty much that whole Station Road area, from the station up to where it joins Hills Road and then turning right into town. So hopefully that provides a bit of context for what I'm about to speak to you about. Well, Dan mentioned rental growth and offices in his presentation, and I think we're quite fortunate in Cambridge as the occupational market has continued to go great guns despite COVID. Take up last year was 475,000 square feet, which is actually only 60-ish% of average annual take up, which is typically 700 to 800,000 square foot per annum. But there were a couple of notable deals in Cambridge with a company called MathWorks taking just under 100,000 square feet in phase 1 Cambridge Science Park. And then the city centre, a serviced office provider called Fora, have taken 65,000 square feet in CBD at 10 to 20 Station Road, and they're paying a headline rent of £48.50 a square foot. You can see from this chart how rents have really grown since the financial crisis in 2008. They've sort of grown by sort of 15% in 2015, which was when Microsoft and Apple first arrived in the city centre from the outskirts and from King's Cross, coming up to central Cambridge. And then they've grown by sort of 19% in 2018 and a whopping 35% in 2020. So significant rental growth, and this is being driven by the lack of supply versus the demand from particularly these tech occupiers to be located amongst their peers in the centre of Cambridge. And if we look forward to what's happening, or what we predict will happen going forward, you can see this chart here just shows the prime city centre CBD and the Northern Fringe in blue. You can see that rental growth is forecast to rise and fall in line with supply, but it's fairly conservative. Prime rents looking to reach £52 per square foot in Cambridge in 2025. I mean, you know, it went up 35% in 2020. So over the course of 5 years, you could see that being significantly beaten, and £40.50 per square foot on the Northern Fringe. Again, a fairly modest increase. And to be honest, some of the pre-let buildings at the Northern Fringe are already quoting £40 a square foot. So these rents could drastically shift. The only observation I'd give on this really is that there's quite a lot of supply forecast for the Northern Fringe area around the new Cambridge North station at CB4. And this could shift the focus from the CBD to Cambridge North, and that could dampen the rise of the CBD rents to the sort of £50 per square foot that we anticipate. So although there's been a reasonable level of activity amongst the occupiers, it's really the investment market in Cambridge that's had all the spotlights and the publicity on it. And the graphic below just shows how or to my left even, it just shows how yields have moved over the last 14 months, with Evolution Business Park there trading in January 2020 at a 5.7% net initial yield. This building's anchored by a company called Cambridge Medical Robotics, who make the arms, the robotic arms that which doctors can do surgery with remotely, and which you may have seen recently on the certain telephone advert. But that deal was completed at £28 million at 5.7%, and you can really see since then up until the buildings on the right there at 418, 436 Cambridge Science Park and 214, 240 Cambridge Science Park, yields are compressed by 150 basis points, and this really illustrates the steady downward pressure on yields as the life science and the biotech funds move in, looking to place cash in Cambridge. And what's quite interesting about these deals from my perspective is that all but one of them are long leases. Typically in a regional submarket, you would expect to be buying freeholds, and the fact that all these science park buildings are all long leases with ground rents to pay, it's just amazing really that the yields have got to where they've got to. But I would say there's a variety of reasons why investors are looking to place money here. Four of these deals were by local authorities who, of course, have their own need for income and to place cash. But the two deals on the right there in the dark blue, which are sunk below 5%, those were assets purchased by Brockton Everlast in competition with some other well-known funds, and they clearly see Cambridge as a safe haven for capital. And as we all know, an incubator for fast-growing tech and life science companies, which are all very fashionable at present. So I thought it'd be worth just looking in more detail at one of these deals and just seeing why these prices are being paid for these assets. And please excuse the, I'm aware that the £1 billion Cambridge investment, 100 million, it is not a billion. The reason that's there is because £1 billion was the weight of money that was chasing this particular asset when you put all the funds together, and it was picked up by one of the property press headlines, and I thought it was quite catchy, so I've used it here. But the question for me is, have we reached peak Cambridge? And this most recent deal at 240 Cambridge Science Park is worth examining a bit closer. This was an asset that was bought by Brockton, who also bought the Fora building, which I mentioned in CB1, which has just achieved £48.50 a square foot. On the face of this particular deal, paying nearly 100 million for an asset which was priced by the selling agents at 62 million seems to defy commercial investment logic. So we scratch the surface of this deal and just see why this price was paid. There's 5 buildings here with 3 tenants and a low average passing rent of £26 per square foot, and it sits on a site of just over 8 acres. If we take the passing rent of just under 4.5 million and reflect this against the 98.7 million purchase price, this is a 4.2% net initial yield, which is expensive. But the site does have plenty of development potential, and capacity studies suggest that a scheme of closer to 413,000 square feet could be developed safely over time, especially with the adoption of the local area action plan, which is the last major regeneration area for Cambridge on that northeast fringe around the sewage treatment works and between Cowley Road and CB4. So if we assume this new scheme that Brockton are proposing lets at the £40 per square foot that we predict rents are going to rise to, and it achieves a conservative yield of 5%, I mean, this generates a GDV of £330 million off £16.5 million rent roll. And if you look at that in the context of paying 98.7 million, it doesn't look as aggressive. And whilst we need demand to keep up with supply, this deal alone suggests that the growth of Cambridge and the benefits this will bring to the wider region still have quite a long way to go. So I hope that's provided a useful summary for you. And I'm now going to pass back to Dan to just give his thoughts on the future of the office. Thank you.
Right, thanks very much, Will. So yes, I'm just going to look at some views on the long-term outlook for the office market. So there are many drivers of change within the office market at the moment, and I've got some images here to take a bit of a break from the many charts that I've shown you. And I guess at the top left is remote working. That's the thing that everybody's focused on at the moment, and I'll talk a little bit about that in a second. But really, there are lots of other drivers of change going on. You know, as we go through the images, there's you know, population increase. There's you know, 200,000 people are being added to the UK's workforce every year, and some of those will undoubtedly work in offices. Artificial intelligence is going to be a huge driver of change in the office sector, and I'm actually very upbeat about its impact. You know, I think it may overtake some of the mundane jobs that are done in offices, but actually I think it will increase the quality jobs that are actually going to be done in offices. So that's another huge change that will take place over the next decade. On the next line, you know, we've got infrastructure developments, you know, got HS2, obviously the East-West Cambridge rail link and so on. That will all provide opportunities. We've got many changes to the planning system. For example, the Class E, which has come in, which allows greater flexibility for offices to change to other uses, for example, retail. We've got the government's levelling up agenda. You know, they've announced that 22,000 civil servants are going to be moving out of London to the regions, including to Darlington. So that creates opportunities and change. And we've also, of course, got the impacts of Brexit still, particularly on the financial services sector. And underpinning everything really is the ESG agenda. And I think particularly a focus on health and well-being of employees will have major impacts on the office market as well. So the office market is being driven by a wide variety of things, and actually quite a lot of those are actually real positives for the market. So it's not just about an increase in working from home or remote working. So I thought I'd now look at the remote working revolution from three different viewpoints. Firstly, the corporate viewpoints, then from the employee viewpoint, and finally from that of investors. I've got a chart here of, it's a survey done by the ONS, the Business Insights and Conditions Survey, done last month, and it asked businesses, what percentage of your workforce do you expect to return to their normal place of work on any given day post-COVID? And I guess the first comment is quite a lot of them didn't know. You can see in the grey bars there, around a third weren't particularly sure. And more than that, you can see I've put the results for all industries, and then some kind of more office-based industries on the right-hand side. So a lot of employers actually still don't really know what's going to happen. But then if you look at the green bars, that's the number that thought more than 3/4 of their employees would return to their normal place of work. Well, only about 37% of all industries thought that. And if you look at information and communications, only 15% of employers think the majority of their workforce will return. And a quarter of respondents in ICT thought that less than half their employees would return. So this suggests that corporates are expecting a major shift towards working away from their place of employment. There was a survey by Deloitte. They do a regular survey of chief financial officers. And in this survey, 97% of CFOs expect an increase in flexibility or working from home in the longer term. And they expect a 5-fold increase from pre-pandemic to 2025 expectation, which you can see in the chart there. 5% of employees working from home pre-pandemic, rising to more than 25% expected by 2025. And YouGov also did a survey late last year. 25% of business leaders had changed their mind positively about home working, and 74% of business leaders surveyed were positive about home working. So this suggests not just a change in what they think is going to happen, but actually employers really embracing the concept of working from home. From the employee viewpoint, this chart shows a recent YouGov survey of employees. This is actually not just office employees, this is across the whole economy. And nearly 70% of people surveyed reported never having worked from home pre-COVID, whereas in terms of their preference post-COVID, only about 40% want this to be the case going forward, that they never work from home whereas those working full-time from home has gone up from 10% to 20%, would like to do that in the future. And those working part-time, 20% before, 40% would like to do that in the future. So again, suggesting that employees are embracing this. And finally, from the investor viewpoint, I've got a chart using MSCI data on average equivalent yields by quartile. So this is a way of breaking the market down by quality. So this is looking at office yields by quality, the red line being the poorest quality and the green line being the best quality. And really, it's an indication of how investors are viewing it. And that green line, good quality property, that hasn't actually seen much of a shift in yields. So implying that investors haven't really changed their mind. It's only really in that poorer quality property, particularly that red line, where you're seeing yields going up distinctly, meaning that investors are prepared to pay less for that property. So really suggesting that investors certainly aren't panicking, and particularly are still pretty have a pretty robust view about prime quality offices. So all of that suggesting that there is going to be a shift brought about by a combination of what employers want, what employees are seeing, and investors being fairly positive about it. And of course, we'll still need offices, and this slide really points out some of the I guess fairly well-known reasons why we'll still need offices around collaboration, team interaction, and innovation. We've all got used to doing things on Teams, but it's no replacement for actually having a face-to-face meeting. Informal communication, that sort of water cooler conversation that we've missed out on. Training and supervision. You learn by being around your colleagues, and some people, really need fairly close supervision in person. And offices create a sense of purpose and shared values, and they certainly promote staff health and well-being, which, as I said earlier, I think is going to be a key theme going forward. And of course, some functions will always need to happen in an office for security reasons and so on. And we mustn't forget that many homes are just not suited to extended home working for a variety of reasons. So overall, we think demand for office space will be lower going forward, but the factors above, favour really sort of high quality, lower density space, and that's kind of very, very much a positive. That I guess we may find we actually use more space per employee than we did before, and the office has really become a choice, not a necessity. I think somebody commented recently that the office actually needs to be nicer than your own home to encourage people to come in. And I think we're going to see a shift, but it's certainly not the end of the office. So really some conclusions there on the future of office demand. As I said, there'll be many long-term drivers of change. It's not just about that remote working revolution. A permanent shift to remote working, which is driven by both employers and employees, but it will mean a lower overall demand for space, and the office as a positive choice, not a necessity. And really, it's an increased focus on all these sort of collaborative, innovative functions and health and well-being that's really going to put the focus for offices on high quality, well located, lower density space. It's all about providing that quality space. Of course, that means higher vacancy for secondary property, and inevitably increased obsolescence and conversion to other uses. And all this will take time to feed through, of course. We've got obviously leases which need to reach breaks and expiries. As we saw, a lot of firms still not quite sure where we're going to be ending up sort of at the end of all this. And I think we're going to see further blurring between the traditional landlord and the flexible leasing models. It's becoming increasingly about flexibility. And of course, there are wider implications around this for city centres, as there are fewer office workers in city centres, and really that spare space needing to be converted to other uses. So significant change within an urban context. So that's really a summary of how we see the longer term future for the office market, which I hope you found useful. And I am now going to hand back to James.
Good morning, everyone. I'm not James. My name is Luke Prout, and I'm a corporate tax partner, one of two corporate tax partners today. Sorry, one of two tax partners today, speaking around the tax issues of commercial properties. Whether you are a business looking to move premises, acquire premises, lease premises, or if you're an investor looking to acquire premises in regards to for a yield. I'm going to talk for the first sort of 20 minutes on the sort of the business side of things. So I'm going to cover capital allowances again, for those, but I'm not going to go too much into detail on those this morning. I'm going to go through the costs of. So if we acquire a property, the difference between whether it's capitalised or whether we can expense it to the profit and loss account. We're going to go through a little bit on what's the tax relief, or how can we access capital allowances if we're buying second-hand buildings, so buildings that are second-hand rather than construction from the ground up. And then finally, I'm going to sort of tail off with a little bit on land remediation relief, so costs of restoring land and buildings from a contaminated state to an uncontaminated state. So first, I'm going to kick off with capital allowances. If you've heard me go through on the budget update, you would have heard me go through all these changes. So I'm going to recap on some, and obviously there's a few updates since the finance bill was introduced back in March early this year. The finance bill, so the Finance Act, had its last reading in the House of Lords on the 8th of June, and it's now waiting for royal assent. So there will be no further changes. So we're pretty much happy that everything that's in there is final. No further changes. First of all, let's talk about super deductions. So it's the question I get asked the most at the moment. The temporary first-year allowance rules to stimulate investment, whether you are a owner-occupier or, as what was changed, whether you are a landlord. So originally, when these rules were first announced in March 2021, it was the landlords or leased assets, you were excluded from claiming the super deduction or temporary first-year allowances for special rate assets. That has been changed in the finance bill. There was an amendment made to it. So now if you are a landlord, a commercial landlord, or, for example, you acquire a commercial property in your holding company for leasing to a subsidiary company, any assets included in there, whether you construct it from the ground up or whether you acquire it as a second-hand asset, and we'll discuss that a bit later, will qualify for the super deduction and temporary first-year allowances. So that was a very much welcome change. So what does the super deduction? What is the super deduction? Well, it runs from the 1st of April 21 to the 31st of March 2023, and it's only available to companies. So we are looking at corporate investors in commercial property, or we're looking at obviously companies that acquire offices or industrial units or commercial property for use in the trade. It applies to plant and machinery and special rate items. And I'm going to go through the difference between that in a moment. It's new assets only. So the super deduction will not apply to second-hand assets. So again, when we look at buying the second-hand building, we can't claim these, but we can claim normal plant and machinery and integral feature assets. So we'll go through that. It doesn't apply to cars, anything bought from a connected person, gifts, or of the year of the cessation of your trade. And there is a rule for contracts entered into or after March 21. So if you were committed to construct a building and that contract was entered into, say, the 26th of February 2021, then potentially, if that contract was entered into, then you might be excluded from claiming super deductions and first allowances. And that's something we've been looking at with many of our clients. We have been reviewing contracts. Now, simply rescinding a contract and then enter into it again after March 21 is a no-no. HMRC have got a piece of anti-avoidance legislation that stops people doing that because the only reason for doing that is for tax avoidance purposes. So what is the super deduction for plant and machinery? Well, it's 130% relief on expenditure. So what that means is if I spend £100,000 on say, for example, a piece of plant and machinery in my building, maybe it's a new production line like this, you will get tax relief for 130%. However, if you dispose that item before March 23, you do have to pay the 130% back. However, after March 23, you only have to pay 100% back. And there are transitional rules covering that, so where you might have to pay a percentage of that back. But essentially, it's 130% relief on expenditure on plant and machinery. I'm going to go through what plant and machinery exactly is in a moment. Turning to, so just an example here. So I've been through an example. So why this is a real benefit at the moment is, okay, factory installs a production line, £3.5 million in 2022. The relief they are getting, tax relief in year one, is 864,500. So that's real tax relief, cash terms relief for them. Without the super deduction, it would have only been £275,000. So they are nearly £600,000 better off by claiming a super deduction now. Now, it's not all as good as it sounds, because actually the corporation tax rate is increasing to 25% from March 23. So this gives you an effective rate of relief of around 24.7%. So the idea really behind the super deduction at 130% is to, if the rate of corporation tax is going up to 25% from 31st of March 2023, businesses will genuinely defer their expenditure until they get relief at a higher rate. So the super deduction effectively makes sure that businesses aren't deferring their capital expenditure. And capital expenditure in a time of economic recovery is very important investment. So that's why these rules are brought in. But there again, there are some winners. And if you look at the integral features, the 50% first year rules for integral feature assets, that is actually a benefit, more of a benefit than this. So special rate assets. So yeah, so plant and machinery assets will effectively, it is genuinely movable items within the building. So we are talking the obvious things. So if you looked at it inside a commercial building, it's your tables, it's your chairs, it's your computers, it's a lot of things. But actually, when we look at a commercial building, there are plant and machinery assets that are fixed to the building that still qualify, that you can't essentially pick up and move, but they are plant and machinery allowances nonetheless. Now, we do have what we call List A, List B, and List C. So List A and List B are items we are not allowed to claim allowances on. So, for example, things like walls, floors, ceilings, doors, the fabric of the building, we generally can't claim plant and machinery allowances on. Now, List C are items within a building that we could claim allowances on. And I'm going to go through that some detail. I'm going to go through an example in a moment, but we are talking things like carpets, burglar alarm systems, cookers, kitchen equipment, kitchen units, sanitary ware, toilets. There are many items within a building that qualify for capital allowances and the super deduction if you are in the middle of constructing a new building from the ground up, or you are looking to construct a new building from the ground up. Now, what we have to do is it's more easier to identify the assets you can pick up and move as to where we claim allowances on them. But if you buy a table's £1,000, we can see it's a table. However, when buildings are constructed, we are looking at detailed schedules, the builder's schedules, and there could be hundreds of invoices. There'll be detailed constructions. Some are better than others. I've got one at the minute where a client spent the best part of £300,000 on something, and I have got a builder's invoice that says £300,000 key term. There's no backing information to it. So how can we extract the allowances from these large capital expenditure costs? Now, just a quick one on special rates. So what are special rate assets? So the 50% first year allowances, they are hot, cold water systems, heating systems, lifts, electrical systems. Currently 6%, you get a writing down allowance of 6% writing down allowance per annum. So that takes, to get 95% tax relief on something that is a special rate item, can take around 60, 70 years. It's a long time. So the fact that you can get 50% first year allowance in year one on special rate assets is a massive advantage. Plus also the annual investment allowance of £1 million, which we currently have until the end of this year, actually makes, because if we just go back to the slide, this is outside of the annual investment allowance. So you just get 130% on plant and machinery regardless. The AIA is not really applicable here because it's a straight 130%, no limit at all. You could spend £100 million on plant and machinery, you get 130% relief. So this effectively is now worth £2 million, because if we spend £2 million on special rate items, we can knock £1 million off. We get first year allowance of 50%, and then we can knock £1 million off. So effectively, this is worth quite a lot. And the tax relief here is 6% per annum. So we could take many, many, many years to get relief. We can get relief a lot sooner. And that's the aim of the game with capital allowances. It's about getting the tax relief as soon as possible, because you will eventually get tax relief for capital allowances. It's just when you get it. It's no use getting relief in 20 years' time. Let's just look at an example, and we'll just put this all into a little bit of context. So, new offices constructed. These are the offices we're in. They were actually built last July. So new offices are constructed. What would we do to effectively extract the capital allowances within this building to claim the tax relief on? Well, we would effectively obtain all of the schedule of costs. So the architects, the builders' costs, and mechanical engineers' costs. We would obtain as much information as possible. We would also then carry out a survey on that building. So we would go around the building and we would survey it to effectively tie up the costs to the expenditure. Very, very important to survey buildings when claiming allowances. We would then categorise the cost of the building into three categories. We would look at plant and machinery first. We would look at special rate items. And then anything that doesn't qualify for plant and machinery or special rate items, we will then claim structural buildings allowances. And in most circumstances, we could claim structural building allowances, and that's 3% per annum. So that's a bit of a slow burner. So we want as least in the 3% as possible. We want as most in the 330% as possible. And then we want to try and get and utilise our £1 million AIA within the special rate items. So within a building, as I say, what would we find in this building that would qualify as plant? Well, it's fully carpeted. So carpets are plant and machinery. Wooden flooring isn't. The fire, the electrical, the mechanical engineering systems within the building itself, the security systems all qualify. All the wiring, all the everything from start to end. Kitchens, so we've got units, we've got taps, we've got white goods, we've got hot taps, we've got all sorts of things within the kitchen. Toilets, we've got the showers, we've got the sinks. Ironically, the cubicles don't qualify for plant and machinery allowances, but the toilets do. And that's the JD Weatherspoon's case. Networking points, wiring, So the wiring in regards to networking points and communications. And we've got motors on doors, windows, door closers, and if there's a moving part, they are classed as machinery. So therefore, a door closer is a moving part, so you can claim the plant and machinery on that. And door closers, they're not cheap, and when you've got 85, 90 in this building, they soon add up. Signage, movable partitions that are designed to be moved in the course of its trade. So they are designed to be moved around. That's their job. They will also get plant and machinery items. What would get the special rate, so the 50% first year allowance? Well, we're looking at central heating and hot water systems, cold water systems, and that's from point of entry in the building onwards. So anything up to the point of entry in the building does not qualify. Electrical wiring, lighting, air conditioning systems, the controls for air conditioning systems, solar shading, solar panels. There's a lot of items there that qualify for that, and all of this we need to extract when buildings are being constructed to get the best tax relief, the best bang for your buck. So that's on the construction of a new building. But what if we've either had the building for a while, or we are looking at acquiring? So we're looking at becoming a tenant within or we're buying a building, or we are becoming a tenant within a building. We need to look at the difference between revenue v capital. So if it's a capital cost, it goes onto the balance sheet. If it's a revenue cost, we get it goes to the profit and loss account. So it's not within the capital allowances rules, it's not within the excluded rules, we just get a tax deduction as normal. So got two main cases for this that sort of they go back to 1923 and then, well, not recently, but 1971, the difference between what's revenue and what's capital. So if we look at law shipping, if you've done your studies, law shipping is always discussed in your studies. If you acquire an asset and you have to incur costs on that asset to bring it into use, so that asset is not usable, or you acquire it at a substantially reduced price because it's not usable, and you have to incur costs to bring it into use, then it's capital. So those costs are capital. So we have to think about capital allowances, whether it's any excluded items. So it's capital. Sorry, the sandwich man's outside. Please excuse me. It will stop in a minute. There we go. No, it's still going. There we go. So it's capital. So this was a ship that was aboard and it was partially sunk. So costs were incurred to bring the ship back into use, to refloat the ship. It was deemed to be capital cost. But as we look at Odeon Cinemas, so Odeon Cinemas bought a cinema. It was dilapidated, very, very dilapidated, but it was in usable condition. It was open to the public at the time, and the price was substantially reduced. On that basis, Odeon Cinemas refurbished the cinema all the way through to bring it back to a good condition. But because it was a usable asset in usable condition, those costs were allowed to be revenue. So it's something we deal with quite a lot, and it's something we get asked quite a lot, is looking at the revenue and capital divide. Now, why is this important? Why does it matter? Well, capital allowances aren't available on, as I say, we talk about list A. We talk about walls, floors, ceilings, doors, gates, shutters, windows, stairs, drainage, sewerage systems. So these very expensive civil parts to a building do not qualify for capital allowances. So if we did have to replace or repair something quite substantial on a building, we would want them to be revenue. So I have, for example, had a client acquired a 3-story office building. It was currently let out at the time. Looked like it had not been updated since probably 1989, but nonetheless, it was completely usable and it was completely lettable at the time. They undertook basically when tenants vacated each floor, they incurred quite a lot of cost on effectively bringing them up to sort of the naughty standards. So I'm talking, I think, 2012, 2013. So they brought them up to standard. So new carpets. They didn't change the layout of the building very much, but they predominantly refreshed it, replaced old for new. HMRC did inquire into this, as I'd expect. They spent a couple of $100,000. HMRC accepted because we had before and after pictures. They could see the floor plans before and after. They accepted the majority of it was repairs. However, I have a client, for example, they acquired an office building, office premises, and they decided it was all cellular type offices, and they decided to knock all the partitions out, make it fully open plan, and put in glass offices. That's not deemed to be repairs or replacements, that's new. Then again, those glass partitions would be capital. So there is a divide between revenue and capital. And when we look at refurbishment or replacement expenditure, we do have to analyse this very carefully to make sure we sit on the right side of revenue and capital. For example, replacing a roof. We replace a roof, and the asset is the building, so if you replace part of the asset, you would get revenue for it on the whole roof. However, if you decided to replace a flat roof with, say, a pitched roof and put storage in there or something beyond what it was before, then that would be a capital cost. So we do have to look at that in some isolation in regards to revenue v capital. As you can see, whether you're buying a commercial property, building a commercial property, refurbishing a commercial property, it's very important to speak to us to get this right. Because, as I say, there's a lot of relief to get there, and the earlier we have these discussions, the better we can make sure that cost gets you the tax relief a bit earlier. Second-hand buildings. So if second-hand buildings. So if we buy a building, a commercial property, and we are entitled to claim capital allowances on the plant and machinery and the integral features within that building, but we simply can't just claim them. We have to do a little bit of due diligence. So if you're looking at buying a commercial property, again, speak to us as soon as possible, because we need to do some due diligence. There was rule changes in 2014 where they were tightened and some conditions were introduced. Whereas before 2014, we could do a little bit of due diligence on the previous year's history and then claim the allowances under a just and reasonable apportionment claim, or what's called a Section 562 calculation. We can't anymore. We have to claim the allowance. So if you're buying a second-hand building, to claim those allowances, the seller has have to have pulled those allowances, and they will need to legally transfer those allowances under what's called a Section 198 election. All of this should be detailed within a CPSE contract pre-sale inquiry form that they'll issue as part of the transfer. I can probably guarantee 90% of the time it will say not applicable, which is not the case. So there is the potential to lose allowances. Now, if you're buying a property and that seller has owned that property before 2009, and we can establish that they've owned it before 2009, then we don't need to elect with them to claim the special rate items. We can just go in and claim them, because the rules were introduced in 2009, therefore they wouldn't have been allowed to claim them. So again, second-hand buildings, again, claiming the capital allowances on them, it's not an easy process, but we do need to make sure that you're in the best position to claim the allowances that are due to you, and again, it ends up becoming a bit of a bargaining tool between the seller and the buyer. 70% of the time, the seller hasn't actually claimed allowances. So what I've had to do before is go and do the survey and then agree with the seller's accountant to put through the allowances. The the seller usually then claims 1 year's worth of allowances as a payment, and then we get the balance transferred over to our client as part of it. I've done that very recently with a client of mine with a property in Ely. Right, lastly, land remediation relief. So this is, I'm just going to quickly go over this because I don't want to jump into Jenny's time. but it's relief for if you are acquiring buildings or land in a contaminated state and you incur costs in restoring that back, and you are not the pollutant, so you can't have made the problem, but you have acquired it with a problem, and as a result of an industrial activity, the building is causing harm. It could cause harm, or as a potential, it could cause significant pollution. Then the cost of remediating that, you get relief for 100% plus an additional 50%. Why relief for 100% plus an additional 50%? Well, if we go back to capital costs, work on land is not deemed to be capital. However, for land remediation relief purposes, if you are the occupier, you can actually claim a revenue deduction for that 100% plus an additional 50%. So it's definitely worth looking at. And what does it cover? Well, for example, you could acquire something that's previously been used for landfill, petrol stations, so removing of tanks. If there's been previously, so if it's a brownfield site, we need to, and you have a requirement to make good before you're able to construct, then you can claim the cost of that. Asbestos removal is the biggest one we see. You're having to remove it. But there are some natural, so we talk about industrial processes. There are a few natural ones where we can claim. So things like for removing arsenic, we get radon gas, and also Japanese knotweed. And as you can see there, I've put a little picture there of what Japanese knotweed can do to buildings and why it's considered to be an irritant, and the removal of Japanese knotweed, as long as you're not allowed to let it grow past the growing season. So if you leave it there and don't deal with it quick enough, you can't have it. Now, thank you very, very much. Sorry, I've tried to probably fit in probably about an hour's worth of stuff in 20 minutes. But any queries, please drop me a line. More than happy to talk to anybody. And now I'm going to pass over to Jenny.
Thank you, Luke. Thank you, Luke. Yes, I'm conscious of time, but essentially what I wanted to cover today was an update on the changes to residential property. Now, if there are any residential landlords listening, you are no doubt in extreme exhaustion just trying to keep up with the changes. And I think especially as a number of them came into play in April 2020, when, let's face it, we were all dealing with quite a lot of other issues at the beginning of the pandemic. Some of the more recent changes may have by and large passed people by. So there is a lot of detail in these slides, which everybody will be getting after the session. If I don't manage to cover everything in as much detail, keeping to the time restrictions. But as you'll see from the first couple of slides here, these are the changes from 2013 moving on to 2020. So it's been a complete minefield. So to just kind of go through some of the key changes, ATED, which actually is the first on the list, 2013, it's surprising how many new clients that we speak to that don't even know what this is and not aware of it. And as I say, it's been around for a long time. And I think it's just one of those changes that came in and people just aren't aware of it. So in a nutshell, ATED is a tax charge for residential property with a value of more than 500,000 owned in a limited company. So if that applies to you, you need to consider these rules. Now, as you can see on the right-hand side of the screen, the annual charges that can apply here are not insignificant. So if you are thinking of acquiring a residential property of that kind of value in a limited company and you haven't yet done that, this is definitely something you need to consider in anticipation when weighing up the pros and cons. If you already have that level of value of property in a company, then you need to be aware of these rules. Now, there are annual reporting requirements as well by the 30th of April or within 30 days of acquisition if the property isn't held by the 1st of April, as well as the tax charge. The good news is, and why many people may feel these rules don't apply, is there are a number of reliefs and exemptions. I've just pulled out some of the key ones here, but by and large, the two that are most common that we come across that are applicable are where a portfolio of properties are owned in a limited company and they're let on a commercial basis to third parties, and also property developers. So if you fall in these two categories, the good news is there's no annual tax charge. What you do need to consider, though, is you do need to complete a declaration of relief, which is slightly different than the form you need to complete if you actually have a tax charge. But to actually apply the relief, you still need to make an annual form. And I think a lot of people would get to this slide, think it doesn't apply, move on, but actually you are required to still make a disclosure, and there are penalties for not doing that. So 2015, this was the start of some changes for non-residents in capital gains tax. So prior to this change, non-residents didn't have to pay capital gains tax on the disposal of UK property, but when the rules came in on the 6th of April, for UK residential property, capital gains tax has to be paid by non-residents. And this has to be disclosed and tax payment within 30 days, unless that individual is already within self-assessment. Now, what the rules did allow is a rebasing. So the base cost of that property is uplifted to when the rules change. So at least there would be no capital gains tax payable on any gain up to the point these rules changed. In 2016, and obviously this is affecting many people, is the 3% levy or surcharge for stamp duty on additional properties. So if you're adding to your property portfolio that's in your personal name or buying a second home, you've now got a 3% stamp duty payment on top of the existing rates. Now, obviously at the moment, we have the stamp duty land tax holiday, but the 3% would still be applicable even while the holiday applies. I thought it was just important to note at the bottom of the slide how the rules vary for stamp duty across Scotland, Wales, England, Northern and Ireland. And I'm obviously covering today England and Northern Ireland. And it's just a point we see sort of catch people out. Whilst the rules are very similar, there are variations, as there are within the property sort of purchase and disposal, the practicalities of how that's done as well across those three areas, so countries. So it's just worth bearing that in mind, that the rules do vary slightly. Now, there is an exemption effectively from the 3% levy if you're replacing your main home. So in many cases, you're buying your new home, you're replacing your previous home, all happens simultaneously at the same time, no 3% stamp duty is payable. And that's even if you have other buy-to-let properties where you're replacing your main home, that's fine, there's no 3% payable. But if, for example, you're acquiring a new property, you can't quite get your previous home sold in time, and you don't want to lose out on this new home, at the point of completion, you will own both of them. So you would have to pay the 3%. But provided your old home is sold within 3 years of purchasing your new home, you could get the 3% repayment repaid to you. And actually, touch wood, that's one of the areas of stamp duty land tax repayments that's pretty quick to get from HMRC. So we can make claims for that. I'll briefly touch on this point given the time constrictions, but many of you, if you have residential property, will probably be aware that wear and tear allowance was abolished in 2016, replaced by the replacement of domestic items relief. And as Luke sort of went into quite a lot of detail on, expenditure in general, capital and revenue is very important for your residential properties as well. What can be set off against your rental income? What can be set off against the disposal of a property, reducing your capital gains tax? And it's really important to keep your records of what's revenue and capital. You know, we can often look at lots of great planning opportunities to optimise a tax position for landlords, but sometimes it's as simple as the basics, and the organisation of receipts is key to make sure when you come to sell a property, you can keep your capital gains tax liability down as much as possible. The biggie, and perhaps the big area that has many people have addressed and looked at their property portfolio, what's the best structure to now hold it in light of the impact of these rules, is obviously the restriction on mortgage interest It's a little bit broader than that in its in what it covers. Finance costs, it covers slightly more than the interest, but in general terms, it would be the mortgage interest that has been restricted. So previously, mortgage interest was a full deduction, reduced the profits, the taxable profits. Now it's a 20% tax credit, a little bit further down the tax calculation. What does that mean? Well, effectively, if you're a higher rate taxpayer, you're now only getting a 20% tax relief on your mortgage interest. Your tax liabilities have therefore gone up over the last few years. And the tax return you'll be completing 2021 that we can now prepare, the tax year that we're currently in, these rules are in full swing now. The other impact of this that we see is not only the loss of higher rate tax relief, but as I mentioned, because we now don't have the mortgage interest as a full deduction, we get a tax credit. The indirect impacts of this is that your income levels will actually be a lot higher. It might push basic rate taxpayers into higher rate. It might make you lose your personal allowance. And another side effect is if it starts to push you into the higher rate and you have children and you're claiming child benefit, you're now also going to lose some of your child benefits. So naturally, this is an area that's forced many landlords to really take stock of, is this the right structure to own our properties moving forwards? 2019 saw an extension of the rules in 2015 for non-residents. So the rules that came in 2015 that capture capital gains tax on residential properties for non-residents is now into play for all property in the UK. So non-residents disposing of a commercial property, again, will be subject to capital gains tax. We're moving on now to the changes that came in April 2020, which, as I mentioned, many of these may have passed a lot of us by, obviously very challenging time. And these rules, some of these rules just kind of sort of snuck in. Now, this point is quite niche, but if there's one person listening that it impacts and they weren't aware of, I thought it was worth mentioning. And this is basically non-resident companies previously where they hold UK property were subject to income tax, whereas now from April last year, they're now subject to corporation tax. That's obviously a big change, and there are a number of transitional rules. So I just wanted to flag that. Then what we saw also last April, which is coming to light now, and the media over the last couple of weeks have covered how people have been caught out by this and have penalties, which by and large has probably been because of the property market, stamp duty, land tax holiday. A lot more people are making decisions to buy and sell property, is the fact that now for UK residents, there's this 30-day window whereby capital gains tax on the disposal of UK residential property has to be paid within 30 days and has to be disclosed within 30 days. So it really doesn't give much time. And if you are at the stage of completion, it's a good time to sort of get the ball rolling on this, because there is certain things we have to do to be able to submit the return on time. Another point which many of you will be aware of, principal private residence relief. Well, that's an exemption for your home. If you've always lived in your home and you sell it, you've got no capital gains tax to pay. If you lived in a property for part of your ownership of that property and then you let the property out, previously there has been relief for obviously the period you lived in the property, but there's been lettings relief for the period you let the property. And that has now in effect been abolished. And that relief was up to 40,000 per person, so it wasn't insignificant. The only way you can now have lettings relief is if you actually live in that property, which, as I say, in all effect, it's essentially been abolished. So I think this as well, coupled with the finance restrictions, has really had quite the blow to landlords' property portfolios. If you had a number of properties that you lived in and then you let, and you were banking on your principal private residence relief and lettings relief, not having lettings relief now will make a significant difference. A change that came in April just passed, only a few weeks ago, is another change for non-residents. There's now a 2% stamp duty surcharge on buying residential property. So effectively for non-UK residents, if they're buying a UK residential property and they already have other property, they now have a 3% and a 2%. So there's an additional 5% now for non-UK residents buying UK residential property. And to finish, a rule that hasn't quite come in yet, and I'm sure everybody will just bury their heads on this one, is the quarterly filing of the tax return, the self-assessment tax return. Now, I know many of us, it's a struggle to do it once a year. It's no one's favourite job in particular. So having to do this 4 times a year with an annual submission, so effectively 5 times a year, it's going to be something that as advisors and as clients, we're all going to have to start to think about sort of dealing with this sooner rather than later. I think on a positive note, what it will mean is obviously at the moment, we have a tax return come in, we prepare it, the tax year's been and gone. There's very little we can do to improve the tax position of that tax year. We can only look ahead. If we're now dealing with you in real time, having more dialogue perhaps, hopefully we can at least better forecast tax liabilities, and hopefully there will be opportunity to be able to spot planning opportunities by working closer with you. And that's everything from me there, whistle stop tour, but the slides are available after today's session, and of course we'll be answering questions now.
Thank you, Jenny. Impeccable timing. I think you're just about 30 seconds over, but we'll give you that. And thank you. Can I thank all the presenters, Dan, Will, Luke and Jenny, for some excellent content there. The presentations are in the chat for download, or in the download handout section to the right of your screen. We will stay online now. If anybody's would like any specific questions they'd like to discuss with us, please do stay, and we'll try and deal with those as we go through. The presenters, I know, will pick up emails if you want to email them directly as well, and we will share the presentation. But conscious of time, thank you for joining us. For the sessions. Thank you. As I say, if you've got any questions and you want to pose them, if you pose them in the chat, I will then share the discussions. I will say we'll stay on for 5-10 minutes or so if there are questions in there. Thank you. For the presenters, I think we talked earlier that I think people now just finish and let's move on. We don't tend to get so many questions these days. So.
There's a lot to take in there as well, I think.
Dan and Will, thank you for your presentation. I personally found it really interesting because what it did was it gave fact and evidence to people's thinking at the moment. And I think, Dan, your particular thing about the changes in workforce, so many businesses are just going, like anything, challenges they face, whether it's Brexit or a pandemic, that undecided, don't really know, is always a high percentage until there's some clarity. It doesn't matter what there is in the world, is it? I mean, farmers in particular, if you take the changes in the Agricultural Act, most farmers are still way off doing anything about anything, We wait for evidence, so thank you. And interesting, the prices in Cambridge. We're hoping, I live in Lincoln, and we're hoping the ripple effect of prosperity moves up. So. I think on the basis we've got no questions, we can conclude. But thank you both, and I look forward, Will, to hopefully meeting you in person in due course. Down in Cambridge, as you know, we have an office in Cambridge. I haven't been to Cambridge for over a year, so I'm missing it.
Thanks, James.
And we use a web development agency in Cambridge for our web development. So we normally meet at least once a quarter, but we'll be doing those remotely. But I think there's a need to meet up. I think the point is, whilst we all carry on working from home, somewhere along the line we need to physically meet people. It seems surreal engaging with people you've never really met, to have a coffee with or something. But thank you, and thank you, Dan, as well.
Pleasure. Thanks.
Great. We will share the slides. When we do that, I'll probably, if it's all right with you, can I put your respective, or say Will's contact details in as well? Is that all right?
Yeah.
Thank you. No, thank you very much indeed. Enjoy the rest of your day.
Bye. Nice to meet you.
Thank you, Jenny.
Bye.